All right, sweet. I am ready to get started if you guys are. So let me share my screen with you. I I think we have more people than, or we have different people, actually completely different people than we did the last time. So I'll review a couple things that I went over this last meeting, and then I'll go into some other new things that I think you guys will like as well. So going into the investing, the idea of this, my whole goal is to help you be able to go invest, whether you have the knowledge behind it or not, to actually go invest and start making money in the stock market right now. And with that, I teach more of the basic principles and the practices that will allow you to go do that. So for me, I guess just background on me in terms of investing, when I went to BYU, Idaho, I think I took every investing class that was available at that time. And I've done a decent amount of investing since then. I've been able to make a decent amount in the stock market. I've read a bunch of different books, and I've been applying them as well. And so that's where I'm at right now. And the biggest thing, everything that I do is in line with the principles of what a lot of the more successful people are doing as well. So that being said, in terms of investing, going to basic principles and practices, the biggest question that you should ask is why should you be starting now? Like why should you start investing right now? And so let's go into this. Give me 2 seconds. Sorry, I was kicking a few people out of the room. Okay, so going into why you should start right now, the biggest thing is compound interest. So Warren Buffett says that this is literally the magic to, to making money, and it is like one of the most important parts of investing in the stock market. So a question for you guys that you can just think on your own: would you rather, and this is just for a year straight, would you rather $1,000 a day for the rest of your life, or would you rather a penny now, and then each day what you're given is doubles? So tomorrow you get 2 pennies, the following day you get 4 pennies, and it goes on, and you just get that for a week or for a full year. In deciding which one you'd want, you'd probably think, oh yeah, like $1,000 a day for the rest of my life, or 1 penny now and that doubles every day just for a year. Yeah, you'd probably want $1,000 every day for the rest of your life. But if you look at it, $1,000 a day, I just put for a year in this one, will end up being $365,000, which is cool. But if you look at what a penny today and then doubled every day for a year, what that ends up being is a lot of money. So I counted it, and it comes down to 35 zeros, or 35 commas. I put zeros, but 35 commas. And I don't know what number that comes out to be, but that's a lot. And that's just for a year. So that being said, I want to show you guys one other example. I kind of broke this down before in the past, but I want to break it down for you guys again. Is what the benefits of investing right now versus later. So there's a few different scenarios. The first scenario is if we're just looking at a Roth IRA, which I'll define that in a little bit, but basically if you invest $6,000 now and you get the annual return of 10%, if you do $6,000, your current age, we'll say, is 20, and you just invest for the next 10 years, $6,000 each year, then by the end of that, when you retire at, I'm just saying 65, then you'll have $3.2 million. But the total you're actually investing is only $60,000. And so it is a huge change in being able to do that. So that's the benefit of investing immediately right now. Another example just to show the waiting for 10 years. And he's like, oh, like I'll just start investing once I have the money. It's if you wait 10 years, the exact same scenario, but you still end up investing $60,000 in total, then by the time you're 65, instead of the $3.2 million, you'll only have $1.2 million. And you're still retiring the exact same age. Everything else is the same. So the difference in waiting 10 years is an opportunity cost of $2 million, which in my opinion is a pretty big difference. And then going into this is just an example. If you're married in a Roth IRA, you're able to do $12,000 a year. So if you were able to do that for the next 10 years, then you'd end up retiring at the age of 65 with $6.5 million. And then if you, and then this is just a completely different scenario as well. But the purpose of that is to show you guys that if you guys start investing right now, then it will compound every single year. So the next 10 years will work for you so that when you retire, you have even more money to retire with. And it's a lot more important to start now. Even if you're 30, then that number decreases even more between 30 and 40. So that's the biggest thing I want to show you. So going into it, I want to define a few different things for you so that you can understand the foundations. And then I want to go into a little bit of stocks, but the idea is that you have the foundations of what you need to go start investing after this. So my advice, write down questions that you have, and then I'll take any questions you guys have at the very end of this. And then write down anything any thoughts that you guys have in regards to what we're going over. And I'd love to discuss any other topics that you guys have at the end of this, but hopefully this is helpful. Just so you guys know, I'm not giving you guys financial advice. My goal is just to teach you guys what I've learned and what I've used and what I've seen helpful. So going into that, I wanted to find a platform because we're going to talk about a Roth IRA, a platform, and then like stocks in general. And so I just wanted to find a few things. So platform, when I say that's essentially the bank where you're putting your money. So you have TD Ameritrade, you have Fidelity, you have Bank of America. You can do any of those. And so that's essentially what it is the bank where you're putting your money. And then a Roth IRA is a type of account in the bank. So like it's similar to checking or a savings account. Just a side note on a Roth IRA, if you guys are able to, a Roth IRA is by far the best account that you can invest in. The platform that you use, I use TD Ameritrade. It doesn't matter what platform you use as long as it doesn't charge you fees to have a Roth IRA. That's the biggest thing that I look at. For a Roth IRA, the biggest thing is anything that you invest money in, whatever you earn later on, you don't have to pay taxes on. So for example, that $3.2 million or even more, that $6 million, if you invest $12,000 for the next 10 years, then you're retiring with $6 million. That $6 million, if you pulled it all out all at once, then you have to pay $3 million in taxes, which is a bummer. That's a lot of money to pay to the government. But if it's a Roth IRA, then that's tax-free. So you could pull that $6 million out and you don't have to pay any tax on that, which saves you $3 million, but it also, only you invest very little and you make a lot more than that. So hopefully that makes sense. Write down questions that you guys have, and I can go back and reiterate in a second. So the next part is an ETF or a mutual fund. So defining the difference between the two. If you're newer to investing, the biggest difference is one's mutual funds are regulated more than ETFs. So the biggest thing for you is if you're investing in an ETF, it means that you can buy it at the normal time throughout the day that you can buy stocks. So for example, a stock or an ETF, you can't buy at midnight. mutual funds, those are, you can't buy them during the day, or if you do, it doesn't actually go through. You don't actually own part of that mutual fund until the evening, and I don't remember the hours. But so they just happen in two different transactions. All of mine are ETFs. I don't think it matters too much if you're focusing on the long term, what you're wanting to do. But I do ETFs. Okay, so what is the S&P 500? It is essentially the thing that shows us how well the US market is doing in general. So it's like the top 500 biggest companies in the US. And so if you're looking at how well the S&P 500 is doing, whether it's up or down that day, that in general is a good idea of how the US market is doing. And all the other companies as well. So it's been around for a little over 60 years. And since it first started, it has averaged 10.5% return every single year. So anything that we're about to talk about, unless you find something that can beat essentially like 10, 11% return every single year, then there's not really, in my opinion, good reason to buy it, because this is the least risky, however you want to define risky, but this is the least risky way to do it. So hopefully that makes sense with that. I guess just to pause for a second, do you guys have any questions up until now before I transition a little bit into stocks? I know I just unloaded a lot of information. Cool. Okay, well, let me know if you guys do have any questions. Otherwise, at the end of this, we'll break it down even more. But S&P 500, there's an ETF. If you guys are wanting to write this down, all of my Roth, when I was able to invest in Roth IRAs, because they have a limit to where you're not able to invest in your Roth IRA anymore. But in all of the IRAs that I have, whether they're my traditional or Sarah's traditional or my Roth IRA or Sarah's Roth IRA, the majority of everything that are in those accounts, it's just the S&P 500. And so one of the ETFs, this is what you can write down, is VOO. So it's just an ETF that is managed by Vanguard. So it's just VOO that controls the S&P 500. I mean, that just follows the S&P 500. So, okay. So transitioning, we're going to go a little bit more into stocks now that I'm pretty excited about. So I want to define 2 or 3 terms for you that I think are important in investing in stocks. And so we already talked about the fact that unless you can get more than a 10% return, it's not really worth investing in that stock. So the first one is timing the market, which to define that, it is attempting to predict the future by investing in the market when it's down. So it's everything that we hear in real estate. It's like, oh, like, should I buy a house right now? Like it seems like the market's really, really up. Like maybe I should wait for a little while. That is timing the market. And the reason why that's not the best thing to do is because we don't know what the future has in store. Like nobody is able to predict what's going to happen in the future and what's going to happen with the market. And so Warren Buffett, he's one of the biggest people against trying to time the market. But a quote that he has is, forecasts may tell you a great deal about the forecaster. They tell you nothing about the future. And so a lot of people are trying to forecast when the market's going to crash, when things are going to happen, but you can't. And so if you can decide your strategy based on principles rather than just trying to predict the future, then you're not gambling. But anything that you don't really know, that it kind of becomes a gamble. And so if you're not really sure what's going to happen in the future, but you're hoping that it gets better and you're only investing now because of the hope that it's down, the stock market's down and then it's going to go back up, I would see that more as gambling. And the idea of the stock market isn't that you're gambling, it's that you're investing. you're making money for the future. So the question then is, how do you go around that then? If you can't time the market, when do you buy stocks? And that is a different thing, because stocks go down, and whenever I'll go into this in a different meeting, but in looking at their intrinsic value, whatever the stock is worth, then if for some reason it's cheaper than that, then you can buy it. And that's one way. So for example, if an iPhone, if it's worth $1,000 and then it just goes on sale for $750, that's cheaper than what it's worth. So therefore, like that would be a good time to buy it, rather than buy it when it's $1,000, or rather than buy it when the price is even more elevated. So that's one part of that, and we'll go into that in more detail later. But the simpler version is dollar cost averaging. So what that means is, when you're investing in the stock market, then you want to average, you don't want to put all of the money in immediately. So I'll give you an example with a Roth IRA. So you have the platform, we'll say TD Ameritrade, the bank, and then in that platform, you have your Roth IRA. So that's your retirement account. And so you can put all $6,000 into your Roth IRA immediately. That's not actually investing the money yet. That's just putting it into the bank. So it's like putting it into the checking account or whatever it is. Now that $6,000 is there, now you can go invest it whenever you want. And so what I would do is I would take $1,000 or $2,000 and invest it initially in the S&P 500 Vanguard. And then every month I would invest an additional $1,000. That way, if the stock market is up and then it's coming back down, you're not investing all your money at the top. But at the same time, if it's down, it's averaging it out so that you're not losing money. You're not buying it at the wrong time, and you're not having to try to guess or predict when the market is going to go up or down. An example of that as well is invest $500 in Apple stock the first of every month. So if you're just like, yeah, like stock or Apple in general is a stock that I want to own, then I'm just going to invest $500 every single month in that, and it should average out even if it's low or high. So that's probably one of the easiest ways to get around trying to time the market. The first example that I talked about of looking at their intrinsic value, that's something that I can talk about later on in the future. But yeah, so I want to go into Peter Lynch, and then I'm going to go into the actionable items of what you can do. But a lot of the actionable items I'm going to give you come from Peter Lynch. And so I want you to understand his background of what he's been able to do. He actually, after one of his books that he wrote, Warren Buffett called him and said, "Hey, I'm about to have a press conference this next week. Can I use one of your quotes from it?" And he did that. And then, and Peter Lynch obviously recognizes Warren Buffett as, quote, like one of the best investors in the world. But it's cool that they're very much on the same page. And I just want you guys to see what he's been able to do. So remember, the S&P 500 averaged about 10% a year. When he was managing his fund, so he managed it for 23 years, a little over 23 years, but he averaged just about 30% average annual returns over those 23 years. So 30% every single year over those 23 years. And which I believe went through 2, maybe 3 recessions at that time too. Another cool part of it is he outperformed 99% of all other mutual funds at the time. And he was also, that mutual fund that it was the Magellan Mutual Fund. He, just 6 years after fully managing it and investing all the stocks into it, he became the single largest mutual funds, that became the single largest mutual fund in the world. So just to kind of give you background on it, he definitely outperforms everybody else in what they were doing, and everything that he did was principle based, and it leads to success regardless. So that being said, he has 3 pieces of advice, and these are the things that I would suggest as well. Like by far, everything that I do is based on these. The first one is only buy what you understand. So I'm going to butcher the story because I didn't go into the story beforehand, but it's a it's a cool little understanding of it. So his whole idea, invest in what you understand, invest in what is close to you, invest in what you know. And so he looked at his credit card and he realized that a lot of his money was going to this place called Gap. And he talked to his wife, and his wife said, yeah, it's like the best clothing ever. And his daughter said the exact same thing. And so he said, okay, well, can I go shopping with you guys? So he goes shopping with them, and he sees what they do. He sees what Gap was like, and just the experience that he had in the store. And then he could obviously see the brand loyalty from his wife and from his daughter. This is when it just first came out. But afterwards, he follows the next two steps before he buys it. But that's within, I believe, 3 or 4 years, his initial investment, he calls it a 10 bagger, but it multiplied his returns 10x. So within, I believe, 2 or 3 years, if you invest $10,000, then, I mean, yeah, if it's doubling every single year, it's pretty cool. But the biggest part, invest only by what you understand. Just you guys, actually, just to back up, the stocks that I've actually lost money in are the stocks that I don't know, but there's hype around them. I don't really understand what they do, but they do some cool software thing somewhere else that I don't really understand. The stocks that have made me the most money are the ones that I invest in because of, one, I understand them. There's something they're already part of my world. And two, I do my homework on it, which I'm going to go into how to do the homework later with you guys, and understand that they're still a good company that I should invest in. So like one of those examples is Shopify. So when I was in college, we were looking at just online marketing. And so I became a little bit more familiar with it. And as I became more familiar with it, everybody that wanted to be entrepreneurs and everybody that started doing a lot of things online in online marketing, they swore that Shopify, and then obviously Etsy was one of the other big ones. They're like, yeah, this is like one of the best things ever. And so I became more and more familiar with it. And then I did my homework on their financials and how well they were doing and how stable they were. But I invested in it. I believe I invested, I want to say I invested like only like $5,000 in it at $138. Was like the cheap one, was the cheapest that I bought the shares at. And within I think it's close to $1,000 now. So in just a couple of years, it's gone up tenfold, which that's just an example of one that I understood rather than a random software out there. Or another one is Apple. But yeah, so always do your homework. And then last one that he says, invest for the long run. I'll talk about this in just a little bit, but I think that is one of the most important things, is investing in the long run. So the way that I do it, there's a lot of the hype of you can make quick money now, and I don't really follow those principles. And I look at the people that have consistently been able to make money in the stock market year over year, not just recently, but year over year through multiple recessions. And they follow these 3 guidelines. They most importantly, they invest in the long run. So going to the stocks, 2 things. One is when you're buying a stock, because I didn't really define the word stock for you. When you're buying a stock, you're buying part of that company. And I think that is something that a lot of the times when we're investing in companies, we don't really understand. And so if you're buying part of a company, then go just understand the basics of that company. Like go understand like what you're actually investing in, something that you'd actually want to be part of and own. And so would you want to own a random software company that you have no idea what they do that's in China? I probably wouldn't, because that sounds like gambling to me. But if it's Apple, if you think that Apple is a really good company and you're wanting to own part of that, and then you go do your homework and you find out that that's the right company, then go forward with that. So that's the first one. And the second one is, my advice is 5 to 10 years. The advice in general just fluctuates between 5 or 10 years. But the idea is, don't invest your money if you need it within the next 5 to 10 years. The reason being is because it goes back to timing the market. You don't know when the market's going to go up or down. But if you look at when the stock market crashed in 2008, I don't believe it came back for another 2 or 3 years, and it corrects itself. And so it'll have a spike, but I don't believe it fully corrected itself for maybe, I think 3 years is when it kind of broke even, but I think it was like 5 or 6 years before it got on the same trajectory that it was at before. So that's my other advice. Don't invest money unless you're fine not touching it, not needing it for at least the next 5 to 10 years. Yeah, or longer, but that's more the minimum. So does that make sense? I just want to take a quick stop right there before I go into the final part that leads into what you guys can actually start doing right now. But what questions do you guys have for me as of right now? And if you don't have any, that's fine. We can go into it at the very end.
Tanner,
Go.
Tanner, this is Ben.
Hey, Ben.
What's the time limit on that Roth IRA you were talking about earlier?
What do you mean by time limit?
You said there's like you can't invest into a Roth IRA forever. From what I could tell, you were saying, and maybe I was wrong in hearing that.
Yeah. So it's not a time limit necessarily. It's more of when the idea is the government doesn't want to let people make tax-free money. And so once your income hits a certain amount, then you're no longer able to invest in it. And so for the most part, for the most part, a lot of people should be able to continually invest in the Roth IRA. And even people when they peak in their income and it goes up for a while, once it goes back down, then they can start investing in it again. And so, like for example, if somebody retires at the age of 50, they no longer have an income, and they could actually start investing in that again. That's my understanding of that too. But so it's not necessarily a time limit. It's more of restrictions in terms of your personal earnings.
Roger that.
Yeah. So actually, let me go over something really fast, and then I'll go into your questions again, because I think this will help. But have you guys' questions ready? Okay. Thank you, Ben. That was helpful. Okay. So there's 6 categories. All 6, basically any stock that you have is part of one of these 6 categories. Now remember that unless you can beat the general market, the S&P 500, which is unless you can get more than a 10% annual return, then you might as well just invest in the S&P 500, because that is the safest. So there's 6 categories for any company, and I'll kind of break down what they are, like what that means. Is you have slow growers, and by the way, my assignment that's going to be for after this is look at 10 companies that you think that you'd want to invest in, 10 companies that you like, 10 companies that you use on a regular basis, that you think are growing, or companies that you think will beat the stock market in general. And the assignment will be to have you guys categorize all of those companies into one of these 6 categories, which is important because then that's the first part to making sure you have the right story in investing in that company. So 6 categories. You have a slow grower, you have the stalwarts, you have the fast growers, cyclicals, asset plays, and then turnarounds. I'm not going to go into the last 2, the asset plays or the turnarounds. I won't go into those as much, mainly because I think they're less applicable for you guys right now. But just so you guys know what they are, asset plays, it's buying a company or buying shares in a company that if it says that they're worth $50 million, but they own land in somewhere, and then they own a bunch of different assets that, although the because of their revenue is only worth $50 million. But what if they sold everything within their company, it'd actually be $100 million. Then it's investing in things like that. So if I own a company and it's not producing a lot of revenue each year, it's producing $50 million in revenue each year, we'll just say, to simplify it, but it's in Hawaii. And so if I sell those acres and acres that I have in Hawaii, then I would actually be able to sell that for like 500 million. That's the idea, is to invest in companies that have assets. And so that's a deeper dive research. The other one that I'm not the biggest fan of, because simply because I don't have the skill set to go do it, I think I let emotions get involved too much, is turnarounds. So companies that were once really, really good, and then for one reason or another, they nosedive, and they try to correct it and then bring it back up. And so the idea is to buy it when it nosedives, and and then hopefully, based on the changes that they're making, they're able to bring it back up, and then you get a higher return on that. So that being said, let's go into these though. So slow growers, once again, the idea is to make sure that you're getting paid more than 10% annually each year. But these are typically dividend stocks, and these are ones that are growing. In general, they're still growing, so they're beating inflation, they're beating gross domestic product, but they're not growing really, really fast, but they produce dividends, which dividends are cool because it's a guaranteed amount that you get paid no matter what. So I have a stock that I'm invested in that does real estate, and they give me a 14% dividend yield every year, which means I am guaranteed 14% dividend every single year. Plus, on top of that, they're growing decently well. So that's an example of a slow grower, where I'm not necessarily banking on them going and doing crazy things, they're changing anything, but they still can. 14% is more than 10%. Stalwarts, I like these. I think that these are a good foundation for your investment portfolio if you're choosing to go invest in your own stocks. But the idea of these is that it's 10 to 14% annual growth. The number may change in general based on what you're looking at, but they can be upwards closer to like 18 or 20%, depending on what they're doing. So examples of these, you have like Apple, you have Amazon, Microsoft, things like that are stalwarts. But if you're looking at Apple's thinking of doing their Apple car. That's because of the billions, trillions of dollars worth of revenue that they're bringing in. If they started transitioning there, that wouldn't produce significantly more profits. In fact, it'd produce more debt, which means that their company wouldn't necessarily grow any faster, even if they did something like completely different and off to the side. Whereas a tiny company, if they're only producing like $1 million in revenue and they go completely pivot something, then anything more than that is a drastic change. So stalwarts, ginormous companies that are doing good things, are still growing, are still being innovative. And ideally they're slightly beating the market, but they're not doing anything crazy. I like those, by the way. They're a lot of what I have. So fast growers are the ones that are, a lot of times they're smaller. They're the smaller companies that are just building it up right then and there. So here's the benefit to what we have versus financial managers. So financial managers, they don't know these because they look at the fundamentals. The way that they're restricted when they're making the decisions on what stocks to buy, because they have a specific set of rules that they need to follow. So therefore, if they, La Quinta, I'm going to use that as an example. So Peter Lynch has that as an example, where La Quinta, what they did, their whole target market was, they were trying to find, there were businessmen that were traveling. They didn't want Holiday Inn quality. They didn't need the suite, or they didn't need everything nice there, but they didn't want to go stay in a Motel 6 either. So they didn't want ghetto, but they didn't want to pay expensive stuff for a nice lobby, a nice hotel, things like that. And so it was a cheaper price with a higher quality still of Holiday Inn. And a manager, a financial manager wouldn't be able to recognize that because they're not able to, they have so many restrictions in finding smaller companies like that. Whereas for you guys, if you guys go and experience something like that, then, and you're just like, I think this is a really good way. And then you go do your homework and find out that it's tested and proven and it's succeeding, then you go invest in that. And that's significantly more growth. An example of that for me was Zoom. So I bought Zoom like before COVID, that school started using that. And so I bought that. I bought that, I believe it's $60 a share. And it skyrocketed up to, I don't know what it's at right now because I think it dropped a little bit, but I bought it because of the fundamentals of what it is doing. And I think it is changing a lot of the virtual communication. Hence, I mean, we're using it right now. But right after COVID, it shot up to over $500, which it's down now. And now the evaluation I have to make is what is their future growth? And I'll go into that later, but I think that it's good. But that was a fast grower. It was a smaller company that I only knew about because I had it in school. Otherwise, if I wasn't in school, I wouldn't have known about it as early. So that's an example of fast growers. Cyclicals is, these are like Ford. So basically it's predictable profit rise and falls. One of the cyclicals that I own is Vail. By the way, I'm not necessarily advising that you buy any of these right now, but I'm just letting you guys know. So Vail, I like them because of what they're doing, because of how they're super innovative in, they own the majority, a lot of the different ski slopes, but they're cyclical in that most of their profit is coming from, September, October-ish, maybe even November, all the way through until the summer. And then obviously ski resorts are closed. And so most of their profit is coming then, and then they kind of go into debt there. And the reason why I like them is because they're able to switch things so that they stop going into debt. They're able to utilize their land so they start making money during the summer too. But that's an example of a cyclical. Other cyclicals are, you could look at like a cruise ship or something where they peak at a certain month every single year, and it's the same every single time. Ford, a lot of car companies, they're more cyclical. I believe they fall into that category because they have spikes at certain times of the years. So, but those are cyclicals. I think for me, my biggest, I kind of spread them out of those four, but a lot of it is stalwarts, and I think those are some of the best ones. So therefore what I had on my mission, when I was serving my mission, that my mission president would ask this question all the time. It's basically like, now that you have that information, what are you going to do? The two things that I would leave with you guys, and then I want to go, so this is kind of part one of picking your own stocks, is understanding the general idea of which stocks to buy, which ones are just candidates for what you should be looking for and what you want to buy. And then the second one is the part that I'll go into next time, is the financial breakdown, making sure that they're actually good companies that will make you money, not lose you money. So what should you do now? One is open up a Roth IRA. That is my advice. Even if you can't put the maximum in each year, anything is significantly better than nothing. And it's tax-free, anything that you do at the end of it. So I would open that up. And then, like I said, I use TD Ameritrade. You can just open a bank account through TD Ameritrade. If you go onto their website, you can just click it and say, and as you're setting up the bank account or the TD Ameritrade account, it says what kind of account do you want? And it's just Roth IRA. And then the other one, this is one that I think you guys will get excited about because it will give you something that we can do on the next one that will help you guys decide whether these are good, is look at 10 companies that you're interested in, and 10 companies that, like, as you're going throughout the next few days, that you realize that you use all the time. One of them for me was Waste Management. I bought Waste Management. That's doubled. They have really good dividends as well. That one was something that was good for me. I don't know if they're necessarily a good investment now, but that was something that like that was just something that I saw on a regular basis. But like that's part of what I'm actually doing. But yeah. And then so pick 10 companies, and I want you to go research these. Like, I mean, you can go Google these and have a better definition of my general categorization, but slow growers, stalwarts, fast growers, all those, and categorize those 10 stocks into those each category and decide which one it is. And then we can go decide from there, because then you can decide what companies you want in your portfolio and which ones you don't. So there's that. And then the next time, the idea is to help you guys come up with a story. So coming up with a story is basically the reason why I bought this stock is this, and you understanding how they're doing financially and you being able to formulate that story of why you bought that stock, why they're different, why they're unique, why they're going to actually make you money, I think is really important in picking those stocks. And then once you guys can find those stocks that you like, the best part about it is, emotions aside, like regardless of whether the stock is up or down, you don't have to stress because you're buying the stock for the long term, because that you think they'll continually grow. So that's all I wanted to go over with you guys today. So let me stop sharing, and I am open for questions. So what questions do you guys have for me?
I got one, Tanner.
Okay, Ethan.
So what, I guess, investment advice would you give to someone who's about to leave on their mission? Like, should they invest at all, or should they just kind of wait till they get back?
I would. I would open up a Roth IRA if you can, and yeah. And if you have more than $6,000, then you and I can talk afterwards too, and of what you could do with that. But I would just invest it in the Vanguard. So the VOO, because basically the S&P 500, because basically if the only reason you would lose money in investing in that is if if the whole US crashes. So
Yeah, I got a good amount of Vanguard through Robinhood, but I was thinking about like not using Robinhood anymore, doing something else.
yeah, I would open up a Roth IRA at the very least. So, but Robinhood is fine if it just doesn't give you the same tax advantages. So secondary. But yeah, I would do that. I would invest in at least the S&P 500 if it were me, because that one you don't have to worry about for the next 2 years. So yeah, what other questions you guys have? Tyrell, were you going to ask a question?
Hey, Tanner, I have a question.
Okay.
So
Right, you already.
Okay. I think Tyrell said that. I already answered it. That's good.
Okay, cool. So like once you've maxed out your Roth IRA, what would you do next? Would you go like, I know you mentioned like the traditional IRA. Like what would you do? Like what would be like your next step after you've done that, if that makes sense? Like what platform would you use next, I guess?
In terms of tax savings, I don't know any other thing that in general that people could do. I mean, I have a SEP IRA as well, but other than that, you can just go invest in stocks in general. So like you can also go through TD Ameritrade and open up a different platform that is just a standard investment portfolio. Or for me, like I use Robinhood. So I think Sarah's Robinhood, I don't remember. I think she has like 20,000 or something like that in there. And then for mine, like I have, significantly more in mine. But hers is more just S&P 500, and then mine is a bunch of different stocks. But I use that because I don't need to worry about any other tax savings, so I use that. So that's what I would do. Once you get your retirement fund set, if you have additional money to invest, Robinhood works for me.
Cool. Thanks, Tanner.
Yeah. Do y'all have any other questions for me?
Hey, Tanner, I got a question.
Austin Whaley.
Yes. For you and your goals right now, clearly you're talking about one of the dividend stocks that you invested in, and then different categories for growth and income and different things, like different goals. What would you say is kind of like your asset allocation? Like, do you focus about 10% of your portfolio on like dividend paying stocks, or are you pretty risky and you're just focused primarily on growth and like blue chip stocks?
Mine is more heavily, I think, growth, but not speculation. So growth in terms of, well, I don't know. So I guess I have a lot of the stalwarts. So I have like Facebook. I have like 80 different stocks, I believe. I believe like 70 to 80 different stocks. But I have like Facebook, and I bought Amazon when it was closer to 1,000. I think it's now well over 3,000. But things like that. So I have a lot of those. I have less money in the riskier ones, but yeah. So I have like Etsy. That one's done closer. That's done like 5-fold for me. But regardless, my whole goal is not speculation. It's more companies that I think will grow in the long term. And so I have very, very few dividend stocks. I just happen to have that one because I liked what they were doing in general in terms of growth too. But yeah, so to answer your question, it's probably closer to 50-50. 50 stalwarts. If I'm just setting into those two, 50 stalwarts / like more cyclical, but like they're actually growing a lot. And then the other one, 50% more of the faster growing companies.
Gotcha. That makes sense.
Yeah.
Thanks for your wisdom.
Yeah. So I don't know if I have a specific percentage though. Just when I like a stock, then I go for it. So yeah. Any other questions for me? Anything else before I let you guys go? I appreciate you guys coming and listening to that. Hopefully it was helpful. But do you guys have any other questions for me? 1 and 2, would you guys want me to do this again and go into how to break down more of the financial side of a company and solidify whether it's a company that you should buy or not?
Yeah, I'd like to see your, like, I guess, thought process on the financial side, and also what you look at as far as like the overall health of the company, whether it's growing or not.
Yeah, I'd love to. We'll break down the growth. We'll break down debt, the financial side of it, the health of the company, everything. So as much as you can. I think there's a bunch of different ways to do it, but the idea is, I think the general principles of understanding a healthy company are there. But cool. Any last questions before I let you guys go? All right. Well, I appreciate you all. Yeah, we'll probably do this later on. And if you guys want to join, you're welcome to. And we can do the same thing so that people have access to that link. So appreciate you guys. Love you all. And yeah, have a wonderful day.